Welcome to BizPoints. In this episode, we'll be analyzing PepsiCo. PepsiCo's Q3 2024 results reveal a company facing significant headwinds and struggling to maintain positive momentum. The overall trajectory appears negative, with declining volumes, shrinking profit margins, and challenges in adapting to rapidly changing consumer preferences. While the company attempts to maintain growth through pricing strategies and portfolio diversification, the underlying performance indicators suggest a business losing ground in key markets and struggling to maintain its competitive position. Several key factors contribute to this negative momentum. Declining organic volume, -2%, across multiple segments and geographies is a primary concern, coupled with shrinking profit margins, particularly in core North American markets. The company's over-reliance on pricing strategies to offset volume losses further exacerbates the situation. Additionally, PepsiCo's slow adaptation to changing consumer preferences towards healthier options and significant operational challenges, including supply chain issues and rising costs, compound the problem. Despite management's efforts to present a narrative of strategic adaptation and long-term focus, the financial results and market performance indicate a company at a critical juncture, facing the need for more rapid and effective transformation to reverse its declining trajectory. The financial performance shows clear signs of distress. Key metrics reveal a concerning trend. Net revenue decreased by 1% year-over-year to $23,319 million. Operating profit fell by 4% to $3,872 million, and net income declined by 5% to $2,930 million. Diluted earnings per share also dropped by 5% to $2.13. While organic revenue growth remained positive at 1%, this was primarily driven by pricing strategies, masking a concerning 2% decline in organic volume. This suggests that PepsiCo is losing market share and consumer preference, relying on price increases to maintain revenue at the cost of volume. A closer look at divisional performance reveals widespread issues across the company's portfolio. In North America, Frito-Lay, FLNA, saw revenue decline by 1% to $5,888 million, with operating profit dropping by 9% to $1,523 million. Volume declined by 1.5%, with decreases in key brands like Tostitos and Cheetos. Quaker Foods North America, QFNA, faced even steeper declines, with revenue falling 13% to $648 million, and operating profit plummeting 28% to $97 million, significantly impacted by a Quaker recall that indicates serious quality control issues. PepsiCo Beverages North America, PBNA, managed a slight revenue increase to $7,175 million, but operating profit still fell by 6% to $914 million. More concerning is the 3% volume decline in both carbonated and non-carbonated beverages, signaling a loss of market share in the crucial North American market. International operations present a mixed picture. While Europe showed some growth, with revenue up 7% to $3,946 million and operating profit increasing 11% to $728 million, other regions faced challenges. Latin America saw revenue decline by 5% to $2,915 million, while the Africa, Middle East, and South Asia, a MESA region, experienced a 4% drop in revenue to $1,552 million and a significant 17% decrease in operating profit to $197 million. The Asia Pacific, Australia and New Zealand, and China, APAC region also saw a slight revenue decline of 2% to $1,195 million, although operating profit increased by 10% to $262 million. These divisional results paint a picture of a company facing challenges across multiple geographies. While Europe shows some growth, other regions, particularly North America, are experiencing significant declines in both revenue and profitability. PepsiCo continues to face operational challenges and risk factors that further complicate its situation. Supply chain issues and rising commodity costs remain a persistent problem, with the company noting continued higher operating costs in transportation and labor. These pressures are likely to continue impacting profitability unless significant operational efficiencies are achieved. Global economic and political factors pose additional risks to PepsiCo's international operations. The company highlighted ongoing challenges associated with volatile conditions in markets such as Argentina, Brazil, China, the Middle East, Pakistan, Russia, Turkey, and Ukraine. This global instability poses significant risks to PepsiCo's international operations and growth prospects. The regulatory environment adds another layer of complexity to PepsiCo's challenges. The company faces potential impacts from new taxes and regulations on its products, ingredients, packaging, and manufacturing processes in various jurisdictions. These regulatory changes could significantly impact PepsiCo's cost structure and market access in multiple regions. In response to these challenges, PepsiCo has implemented several strategic initiatives. However, these efforts appear more reactive than proactive. The company continues to implement its 2019 multi-year productivity plan, now extended through 2028, with expected pre-tax charges of approximately $3.65 billion. The extension of this plan and the significant costs associated with it suggest ongoing struggles to achieve sustainable efficiency improvements. PepsiCo is also investing in digital transformation, as evidenced by the ongoing migration of financial processing systems to an enterprise resource planning (ERP) system. While necessary, this migration indicates that PepsiCo may be behind in its digital transformation efforts compared to industry leaders. The company's efforts to evolve its portfolio in line with market trends, as highlighted by CEO Ramon Laguarta, are commendable, but may be too slow to effectively capture shifting consumer preferences. We have been working for many years on evolving our portfolio with the trends of the market, and these trends are different in different parts of the world. But clearly, the consumer has been moving in some parts of the world towards looking for more permissible snacks or going into more unstructured meals, end quote. This focus on permissible snacks and adapting to new eating patterns is necessary, but may not be sufficient to drive significant growth in the face of rapidly changing consumer tastes. PepsiCo's acquisition strategy, exemplified by the announced $1.2 billion cash acquisition of Siete Foods, represents a significant investment in the ethnic food segment. While this move aligns with the trend towards more diverse and healthier food options, it also carries risks. The high price tag could strain PepsiCo's finances, and there's no guarantee that the company can successfully integrate and grow this new brand within its existing portfolio. Marketing and brand investment efforts show mixed results. Ramon Laguarta stated, "We feel good about the investments that we put this summer, mostly behind the potato chips category and Lay's. That drove growth in the potato chips business. Lay's gained 3 points of household penetration, and we feel good about that return. Now we're going to apply that sequentially to other categories." End quote. While the company reports some success with brand investments, particularly for Lay's, the overall decline in volume across key brands suggests that these marketing efforts are not fully resonating with consumers. The sequential approach to brand investment may be too slow in a rapidly changing market environment. PepsiCo's reliance on pricing strategies to maintain revenue growth is evident in its approach to offering more product in certain brands and introducing smaller multi-pack options. We're giving 20% more product in Tostitos and Ruffles, some of the brands that belong in those occasions. We're also investing in brand events, end quote. While these strategies may provide short-term revenue stability, they risk further eroding market share if competitors offer more attractive value propositions. The company's focus on the growing Hispanic population in the U.S. and efforts to expand distribution channels beyond traditional retail represent attempts to find new growth avenues. However, these efforts may be too narrow given the global nature of PepsiCo's business and the broad challenges it faces across multiple markets. Despite declining profits, PepsiCo maintains a strong commitment to shareholder returns, expecting to return approximately $8.2 billion to shareholders in 2024 through dividends and share repurchases. We expect to return a total of approximately $8.2 billion to shareholders in 2024, comprising dividends of approximately $7.2 billion and share repurchases of approximately $1.0 billion. End quote. While this commitment may please shareholders in the short term, it raises questions about the long-term sustainability of such generous payouts in the face of declining performance and the need for significant reinvestment in the business to drive future growth. PepsiCo's commitment to long-term sustainability and transformation is commendable, as evidenced by ongoing investments in advertising and marketing, long-term company transformation, and sustainability initiatives. Ramon Laguarta stated, "Even in a year like this, we're challenged on the top line. We keep investing in A&M. We keep investing in the long-term transformation of the company. We keep investing in sustainability, making sure that long-term we are using less resources," end quote. However, the effectiveness of these investments in driving business performance remains to be seen. The company must balance these long-term initiatives with the need to address immediate challenges in market share and profitability. In conclusion, PepsiCo's Q3 2024 results and strategic initiatives paint a picture of a company facing significant headwinds and struggling to maintain its market position. The overall momentum appears decidedly negative, with several key factors contributing to this assessment. 1. Declining volumes across multiple segments and geographies. 2. Margin pressure, particularly in core North American markets. 3. Over-reliance on pricing strategies to offset volume losses. 4. Slow portfolio transformation in response to changing consumer preferences. 5. Operational challenges, including supply chain issues and rising costs. 6. Global economic and political risks impacting international operations. 7. The delicate balance between maintaining high shareholder returns and necessary business reinvestment. While PepsiCo maintains strong brands and an extensive distribution network, these advantages are being eroded by the company's struggles to effectively adapt to a rapidly changing consumer landscape. The reactive rather than proactive approach to market trends, coupled with the slow pace of digital transformation and portfolio evolution, suggests a company losing ground to more agile competitors. Looking ahead, PepsiCo faces a critical period that will determine whether it can reverse this negative momentum and regain its position as a leader in the global beverage and snack food industry. To achieve this, the company must: 1. Accelerate its portfolio transformation to align more closely with health and wellness trends. 2. Significantly improve operational efficiency and supply chain resilience. 3. Enhance digital capabilities to drive more targeted marketing and operational improvements. 4. Better balance shareholder returns with necessary investments in business transformation. 5. Address quality control issues to rebuild consumer trust. 6. Develop more agile approaches to product innovation and market adaptation. Without substantial changes in strategy and execution, PepsiCo risks further erosion of its market position and financial performance. The coming years will be crucial as the company attempts to transform its business model, revitalize its brand portfolio, and regain momentum in key markets. The success of these efforts will determine whether PepsiCo can reverse its current negative trajectory and reestablish itself as a growing, innovative leader in the evolving global consumer goods landscape. If you found this clip useful, we would appreciate it if you could help by liking, sharing, and subscribing, as well as viewing our other clips on other companies. Thank you.